The fastest way you can live off dividends, $3,000 a month. Imagine this. You wake up in the morning, not because of that alarm clock, but because you've had a full, restful night. You grab your cup of coffee, check your phone, and instead of worrying about work or bills, you see money quietly landing in your account. Your investments paying you while you sleep. This isn't a dream. This is financial freedom, and you can achieve it with the power of dividends. In this video, we're breaking down 3 of the fastest ways to earn $3,000 a month in dividends and fast-track your path to financial freedom. Stick around because this might just change the way you think about investing. Dividends and how they work. Before we dive into the strategies, let's take a step back and talk about the most important question: how much do you need to invest? Determining your ideal investment amount. Everyone's financial needs are different. Some people dream of a simple life in a quiet town, where $36,000 per year or $3,000 per month covers everything comfortably. Others have bigger aspirations, travel, luxury, or a higher standard of living. The amount you need to invest will depend on your unique goals and your level of financial comfort. So let's take a moment and picture your ideal life. What does it cost? Once you have that figured out, here's a simple way to look at it. The more you need per month, the more you need to invest. And the higher the dividend yield, the less you need to invest to reach your goal. So what are dividends and how do they work? Imagine you own a rental property. Every month, your tenants pay you rent. Now, imagine owning a piece of a company that does the same thing, but instead of paying rent, they share their profits with you. That's what a dividend is. When companies make money, they have 2 choices: reinvest it into the company for growth, or share it with their investors as dividends. The second option means that as a shareholder, you get paid just for owning the stock. And the best part, many companies increase their dividends over time, meaning your income can grow without you doing anything. Some companies pay dividends every 3 months. Others, like certain ETFs and REITs, pay every single month, making it easier to cover your living expenses with investment income. How dividends lead to financial freedom. Now picture this: a life where you never have to sell your investments to pay the bills. Instead, the dividends keep flowing, covering your expenses while your capital remains untouched. This is what makes dividends so powerful. Unlike relying on stock price appreciation, which can be unpredictable, dividend investing provides stability, because it is a steady income stream even in market downturns. Flexibility, because you can use dividends for expenses, reinvest for more income, or save for big purchases. And most importantly, growth. Many companies and funds increase their payouts over time, helping you keep up with inflation. It's like having a personal ATM that refills itself every month. How to earn $3,000 per month in dividends. To reach $3,000 per month, or $36,000 per year, you would need a plan. To help you build yours, we have lined up 3 strategies. These strategies require a different investment amount to reach $3,000 per month, depending on their yield. Some require more upfront investment but offer more security. Others provide higher income with less capital but at a higher risk. So let's explore these 3 powerful alternatives ranked from good to the best. Strategy number 1: Dividend Aristocrats. When it comes to investing, everyone loves consistency, and that's exactly what dividend aristocrats offer. Stocks that have not only paid dividends, but have increased them for at least 25 consecutive years. Now, let's be honest, 7 to 8% dividend yields sound great, but can they really last? That's the big question. Unlike high-risk stocks that might promise huge payouts, but cut their dividends when times get tough, dividend aristocrats are battle-tested. These companies have survived recessions, stock market crashes, and economic downturns while still paying their investors. So if you're someone who values long-term stability and wants a dividend income that grows over time, this strategy is for you. Let's take a look at 3 dividend aristocrats that offer solid yields and a track record of rewarding investors. 1. Enterprise Products Partners, EPD. EPD is one of the biggest players in oil and natural gas pipelines. Unlike oil companies that rely on volatile oil prices, EPD makes money by transporting and storing energy. That means whether oil is at $50 or $100 per barrel, EPD still collects fees. For dividend investors, this is great news. Steady cash flow means steady dividends, and with a 6.17% yield, it's another strong choice for passive income. 2. Universal Health Realty Income Trust, UHT. This company owns and leases healthcare properties, meaning its revenue is tied to long-term leases with hospitals and medical facilities. Even when the economy struggles, healthcare spending doesn't stop, which makes UHT a strong defensive dividend investment. With a 7.45% yield and over 3 decades of dividend growth, it's a solid choice for reliable income. 3. Altria Group, MO. Altria doesn't just sell tobacco, it dominates the industry as one of the largest tobacco companies in the world. Thanks to brands like Marlboro, it generates billions in profit and has a track record of paying increasing dividends for over 50 years, despite shifting consumer habits. That 7.92% yield? That's real money hitting your account every quarter. Now let's get to the numbers. Dividend aristocrats have historically provided an average total return of 5% per year over the past decade, including dividends and price appreciation. So if we're aiming for $36,000 per year in dividend income, here's what that looks like. $36,000 divided by 5%, that's $720,000. Yes, $720,000 sounds like a lot, but let's put it into perspective. If you relied on a typical savings account with a less than 1% interest rate, you need over $3.6 million just to generate the same $3,000 per month in income. Dividend aristocrats offer a much faster path, with reliable, growing dividends from well-established companies. And the best part, you don't need to start with that full amount. Every dollar invested gets you closer to financial freedom. So if you thought 7% dividends from dividend aristocrats were impressive, what if I told you there's a way to earn up to 12% yields and get paid every single month? Let's move to our next strategy. Strategy number 2, covered call ETFs. Imagine collecting double-digit dividend yields without having to pick individual stocks or manage a complex portfolio. That's exactly what covered call ETFs offer, a way to generate high income by combining dividends with option premiums. Now, before you start thinking, options? That sounds risky. Don't worry. Covered call ETFs handle everything for you. They own a basket of stocks, like the S&P 500 or NASDAQ 100, and use a strategy called selling covered calls to generate extra income. The result? Yields that are significantly higher than traditional dividend stocks. But there's a trade-off: less price appreciation. These ETFs prioritize income over growth, meaning they're best suited for investors who want high monthly payouts rather than long-term stock gains. If your goal is immediate, consistent cash flow, this strategy might be exactly what you're looking for. Here are 3 covered call ETFs for high passive income. 1. JEPI, JP Morgan Equity Premium Income ETF. Instead of selling traditional covered calls, this ETF does something different. It uses income-generating derivatives to create smoother returns with lower volatility. With a 7.13% yield, JEPI offers a mix of income and capital preservation. 2. XYLD, Global X S&P 500 Covered Call ETF. XYLD follows the S&P 500, meaning it invests in large, stable companies like Apple, Microsoft, and Johnson & Johnson. With an 11.53% yield, XYLD provides nearly 4 times the income of a typical S&P 500 fund. 3. QYLD, Global X NASDAQ 100 Covered Call ETF. If you love tech stocks, but also want big dividend payouts, QYLD might be your best bet. QYLD invests in the NASDAQ 100, which includes tech giants like Google, Amazon, and Tesla. Instead of relying on stock growth alone, it sells call options to create a massive 12.38% yield. Covered call ETFs have provided an average annual return of 8% over the past 10 years. So if you're aiming for $36,000 per year in dividend income, divide that by 8% and you have your answer. You'd be needing $450,000. Compared to dividend aristocrats, this strategy gets you to your goal with $270,000 less capital. Now that's a serious advantage. Wait till you see this next investment that pays you like a landlord without the headaches of being one. Strategy number 3. High-yield REITs. Imagine owning a portfolio of apartment buildings, office spaces, and shopping centers, collecting rent every month without managing a single property. That's exactly what real estate investment trusts, REITs for short, allow you to do. These companies own income-generating real estate and are legally required to pay out at least 90% of their profits to investors in the form of dividends. The result? Massive yields, often 10% or more, and consistent passive income. If you want to maximize dividend cash flow while keeping your capital invested in real assets, high-yield REITs can be an excellent choice. That said, here are 3 high-yield REITs for passive income. 1. Orchid Island Capital, ORC. ORC follows the traditional mortgage REIT model, only that it focuses specifically on agency-backed mortgage securities, which are considered safer than riskier private loans. Even with a more conservative approach, ORC still delivers an impressive 17.93% yield, making it one of the top-paying REITs for passive income seekers. 2. Cherry Hill Mortgage Investment, CHMI. CHMI specializes in residential mortgage-backed securities. This means they don't own buildings, rather they profit from the loans behind them. The company earns income from the difference between the interest it collects and the cost of financing its investments. With an 18.52% yield, CHMI provides a huge monthly dividend payout, making it attractive for income-focused investors. However, it can be impacted by fluctuations in interest rates and economic conditions. 3. Invesco Mortgage Capital, IVR. IVR operates similarly to CHMI, focusing on mortgage-backed securities. Because mortgage REITs earn money from interest spreads, they tend to have higher yields than traditional real estate REITs. At 19.21%, IVR's dividend is among the highest in the industry. Just keep in mind, higher yields come with higher risks. So what's the takeaway? Historically, REITs have provided an average annual return of 10% over the past decade. This includes dividends and stock price appreciation. When you divide your expected $36,000 per year in dividend by 10%, you'll get $360,000. That means REITs require even less capital than covered call ETFs, making them the fastest way to hit your passive income target. We've explored 3 powerful ways to generate dividend income: steady growth with dividend aristocrats, higher monthly payouts with covered call ETFs, or the fastest route with high-yield REITs. Each has its trade-offs, but the real question is, which one fits you best? The numbers are clear, the strategies are on the table. Now it's your move toward financial freedom. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.